Under Canadian law, your bank is required to open an account for you. That is federal law, Bank Act Section 627.17. But here is the part they do not advertise. There is no equivalent law that says they have to keep it open. Your bank can close your account at any time for any reason with as little as 2 weeks' notice. They do not have to tell you why, and no regulator in this country can force them to reverse it. A 73-year-old woman in Toronto banked with the same institution for nearly 50 years. She got a letter giving her 2 weeks. No explanation, no appeal. And what happened to her can happen to any Canadian with a bank account. I am Peter Workman, and welcome to Canada Pension News Bulletin. In this video, I am going to walk you through 3 things. First, the legal imbalance in Canadian banking that most people are completely unaware of. Second, what truly happens to your financial life when your bank shuts your account, and it is far worse than most people expect. And third, the concrete steps you need to take right now to protect yourself before it ever happens to you. Most Canadians believe that once they open a bank account, it belongs to them, that the relationship is permanent, that as long as they are not doing anything fraudulent, their account is secure. That is simply not how it works. You have a right to open an account. You do not have a right to keep one. Section 627.17 of the Bank Act obligates federally regulated banks to open a retail deposit account for any individual who presents valid identification and satisfies basic requirements. That provision was introduced specifically to prevent banks from denying access to fundamental financial services. It means that even if you have poor credit, even if you have gone through bankruptcy, even if you owe money to the CRA, a bank is still legally required to give you an account. The government determined that access to banking is so essential to participating in the modern economy that it had to be guaranteed by federal legislation. But the Bank Act contains no corresponding provision. There is no section that says the bank must maintain your account once it has been opened. The obligation runs entirely in one direction. They must let you in. They can push you out whenever they choose. And that imbalance is the foundation of everything I am about to explain. The industry standard is 30 days notice before closure, but that is a voluntary guideline adopted by the Canadian Bankers Association, not a statutory requirement written into federal law. The Bank Act specifies notice periods for branch closures because shutting a branch affects an entire community. It does not specify notice periods for individual account closures, because closing your account only affects you. In practice, Canadians have received as little as 2 weeks' notice. Some have received even less, and none of them were told why. And here is the part that makes this even more troubling. If the bank is closing your account due to a money laundering concern, because their compliance team flagged something about your transactions, they are legally prohibited from disclosing that to you. Section 8 of the Proceeds of Crime Act makes it a criminal offense to reveal the existence of a suspicious transaction report. The penalty is up to 2 years in prison. So the letter you receive says something like, "This relationship no longer aligns with our risk appetite." That is all you get. A vague sentence and a deadline. Let me walk you through exactly how this unfolds in the real world, because most people assume it could never happen to them until it does. The process almost always begins with the bank's compliance or risk management team. Something about your account gets flagged. It could be a transaction pattern that appears unusual. It could be the industry you work in. It could be a name match with a sanctioned individual or a politically exposed person. It could be that you received a sizable inheritance and deposited it differently than your usual pattern. In some documented cases, it was triggered by a single large e-transfer to a perfectly legitimate Canadian financial platform. You do not receive a warning. You do not receive a phone call asking for clarification. You do not get an opportunity to explain the transaction. You receive a letter. The letter states that the bank has decided to conclude its relationship with you. The reason given, if one is given at all, is vague and non-specific. And when you call the number on the letter, the representative on the other end tells you they cannot provide any further details. You ask to speak with a manager. The manager tells you the same thing. You ask to submit a formal complaint. The complaint goes nowhere. The decision has already been made. The Financial Consumer Agency of Canada received over 800 grievances about unexplained account closures between 2018 and 2023. The Ombudsman for Banking Services and Investments handled 419 debanking cases between 2019 and 2024. And here is what makes people the most frustrated. OBSI, the body that exists specifically to resolve disputes between Canadians and their banks, states on its own website that it is not able to challenge or change a bank's decision to close an account. The organization created specifically to protect banking consumers cannot protect you from having your account taken away. The regulator cannot help you. The ombudsman cannot help you. The bank does not have to explain itself. Carol Kahn is 73 years old. She lives in Toronto. She banked with the same institution for nearly 50 years. She opened her account in her 20s. She raised her children with that account. She deposited decades of paychecks into it. One day, she received a letter informing her that the relationship was being terminated. She was given 2 weeks. When reporters asked the bank to comment, they declined. Carol told CBC, "I started shaking and I figured, what is going on? Nearly 5 decades of loyalty, 2 weeks to find somewhere else. No reason given, no conversation, no appeal." And Carol Kahn is not an isolated case. She is part of a pattern. A Global and Mail investigation documented dozens of similar situations across the country. A compliance consultant in Calgary, someone whose entire profession is anti-money laundering compliance, debanked by Scotiabank with no explanation. A Nigerian-born entrepreneur in Toronto, debanked by 3 separate banks over a decade. A retiree in Halifax who had banked with the same institution for over 30 years, terminated due to what appeared to be a case of mistaken identity. In every single case, the outcome was identical: a letter, a deadline, and silence. What most people do not grasp about losing a bank account is that it is not simply an inconvenience. It is not like switching mobile carriers. It is a cascading collapse that touches every corner of your financial life, and it moves fast. The moment your account closes, every system connected to it breaks down. Your employer's direct deposit fails. Your next paycheck has nowhere to land. If you do not already have a backup account set up with your employer, you may have to wait for a physical check to be issued, which can take 1 to 2 pay cycles. That is 2 to 4 weeks without income reaching your account. Your pre-authorized payments for rent, utilities, insurance, and your phone bounce. The companies receiving those payments do not know your account was closed. They see a failed payment, and they treat it exactly as though you chose not to pay. Your landlord sees a missed rent payment. Your insurance company sees a missed premium. Your phone carrier sees an overdue bill. None of them know or care that it was your bank's decision, not yours. Your credit score drops, not because you did anything wrong, but because automated systems recorded missed payments across multiple accounts simultaneously. You now have a damaged credit score because your bank closed your account. And that lower score makes everything harder going forward. Higher interest rates on your next credit card. Higher insurance premiums in some provinces. A more difficult time renting your next apartment because landlords run credit checks. If you were in the process of securing a mortgage, that pre-approval may be revoked. Lenders require an active bank account and a clean, recent payment history. A sudden closure accompanied by multiple bounced payments can push you below the qualification threshold. A mortgage you were approved for last week may no longer be available to you this week. If you receive benefits from the CRA, your tax refund, your GST credit, your Canada Child Benefit, those payments were directed to an account that no longer exists. The CRA does not automatically know your account was closed. They send the payment. It bounces. Your benefit sits in limbo until you update your direct deposit information through My Account. One documented case involved a Canadian who lost access to a $1,300 CRA refund for several months because they did not update their information quickly enough after being debanked. Months without money that was rightfully theirs. And here is the part most people do not see coming. When one bank closes your account, it can make it considerably harder to open one somewhere else. Banks share information through FinTrack, and through their own internal risk assessment networks. A closure at one institution, particularly one linked to a compliance concern, can follow you to the next. It does not mean you will be turned away everywhere. Section 627.17 still requires banks to open a basic account, but it does mean the next bank you approach may already have a flag associated with your name, and they may ask questions you cannot answer because the first bank was legally prohibited from telling you why they closed your account in the first place. You are carrying a mark you cannot see and cannot explain. In February 2022, the Canadian government invoked the Emergencies Act for the first time in that legislation's history. One of the emergency measures was a directive instructing banks to freeze accounts connected to the trucker convoy protest in Ottawa and at border crossings across the country. In 9 days, 257 bank accounts were frozen. The total value frozen was $7.8 million. No court orders were required. No warrants were issued. Banks received verbal instructions from the RCMP identifying account holders whose funds should be frozen. The accounts were frozen. The funds became inaccessible. And the account holders had not been charged with any crime at the time of freezing. Some of them had simply donated $20 to a crowdfunding campaign weeks earlier. I am not making a political statement about the convoy. Whether you supported it or opposed it is entirely beside the point. I am making a statement about infrastructure. The mechanism that allowed the government to instruct banks to freeze 257 accounts in 9 days without a single court order still exists. The Emergencies Act itself was not repealed. The regulations that enabled the account freezing were temporary, but the legislation that authorized those regulations is permanent. The Federal Court of Appeal later ruled that the invocation was unlawful. The government had not met the legal threshold required to trigger emergency powers, but by the time that ruling was handed down, the accounts had already been frozen and unfrozen. The action had already been taken. The funds had already been inaccessible. The damage for some account holders had already occurred. What February 2022 demonstrated is that Canadian banks will comply with government instructions to freeze accounts without court orders when directed under emergency legislation. They did not push back. They did not request warrants. They did not notify account holders in advance. They received a list and they acted on it. The legal framework that made that possible has not been dismantled. The question is not whether it happened. The question is whether it could happen again, and under what circumstances. And this connects directly to debanking more broadly. The same compliance infrastructure that banks use to file suspicious transaction reports with FinTrack. The same risk management teams that decided to close a loyal customer's account after 50 years. The same internal systems that flag your transactions against your customer profile. Those are the identical systems that executed the Emergencies Act freezes in 9 days. The machinery is the same. The only difference is who issues the instruction and under what legal authority. What is happening to individual Canadians is also happening at scale to entire industries. And this is where the pattern becomes impossible to dismiss as a series of isolated incidents. 60% of legal Canadian cannabis companies report significant banking difficulties. These are not illegal operations. These are federally licensed businesses operating within Canadian law, paying Canadian taxes, employing Canadian workers, and the major banks will not serve them. In February 2023, a class action was filed against 6 major Canadian banks, alleging the systematic exclusion of the legal cannabis industry from banking services. That case remains ongoing. The banks argue risk-based compliance. The cannabis companies argue coordinated financial exclusion. In cryptocurrency, Adam O'Brien, the CEO of Bull Bitcoin, one of the largest Canadian Bitcoin exchanges, was debanked by every major Canadian bank. Not because he was doing anything unlawful, because the banks concluded that Bitcoin-adjacent businesses exceeded their risk tolerance. A lawyer in Alberta was debanked by a major chartered bank after making 2 consecutive $1,000 e-transfers to ShakePay, a legal FinTrack-registered Canadian cryptocurrency platform. 2 lawful transactions totaling $2,000. Account closed. 30 days notice. The only justification was risk appetite. In the adult content industry, 63% of creators surveyed reported losing a bank account or payment processor. Not for illegal activity, for legitimate work that the bank decided it did not want to be associated with. In money services businesses, 27 of 39 surveyed were denied bank accounts entirely. That is 69% of licensed legal businesses locked out of the financial system. The banks refer to this as a risk-based approach to compliance. In theory, that means each customer is individually assessed based on their specific risk profile, proportionate, targeted, and fair. In practice, it means entire categories of legal Canadian businesses and individuals are denied access to banking because the compliance cost of serving them exceeds the revenue they generate. The bank runs a cost-benefit analysis, and if you fall into a category that demands more monitoring, more documentation, more reporting to FinTrack, the numbers do not work in your favor. The bank is not making a judgment about whether you are breaking the law. The bank is making a judgment about whether serving you costs more than you are worth to them. And if the answer is yes, you are out. No appeal, no regulator to call, no law that compels them to keep you. Here is what you need to do, and you need to do it now before you ever receive that letter. Step 1. Open accounts at 3 different types of financial institutions: a Big Six bank, a credit union, and a fintech such as EQ Bank or Wealthsimple. This is not about chasing better interest rates. This is about redundancy. Credit unions are provincially regulated. They are not subject to the Federal Bank Act. They still report to FinTrack, but their risk assessments tend to be more individualized because they are smaller and community-based. A credit union in your province is not going to receive the same blanket risk directive from a Toronto head office that a Big Six branch would. If your primary bank closes your account, your credit union account is completely unaffected because it operates under an entirely different regulatory framework. Step 2. Set up direct deposit and CRA benefits at more than one institution. Your employer may only permit one direct deposit account, but the CRA allows you to update your direct deposit information at any time through My Account. If your primary account is closed, your paycheck and your government benefits need somewhere to land immediately. Do not wait until after you have been debanked to figure this out. By then, you are already behind. Step 3. Keep a modest physical cash reserve at home, enough to cover 2 to 4 weeks of essential expenses. If every digital account you hold becomes inaccessible, even temporarily, you need to be able to purchase groceries, pay for fuel, and manage basic costs while you sort out the situation. This is not paranoia. This is not hoarding. Financial planners call it liquidity resilience. And after February 2022, it should be part of every Canadian's financial plan. Step 4. If you receive a closure letter, do not waste time disputing it with the bank. They have made their decision, and no regulator can overturn it. Instead, immediately update your direct deposit details with your employer. Update your CRA direct deposit through My Account. Redirect every pre-authorized payment to your backup account, and contact every creditor to inform them that your banking information is changing. You have 2 to 4 weeks. Use every single day of it. The most severe financial harm from debanking falls on people who assumed they had more time than they actually did. Step 5. File a complaint with OBSI. They cannot compel the bank to reopen your account. I have already explained that, but they can verify whether the bank adhered to proper notice procedures and followed its own internal policies. If the bank cut corners, if they provided less notice than their own policies require, OBSI can recommend compensation. It is not a remedy, but it creates a formal record. And if the pattern of debanking ever reaches a class action courtroom, those records will carry weight. There is a law that says your bank must open an account for you. There is no law that says they must keep it open. 800 Canadians filed formal grievances about unexplained closures over 5 years. 419 cases reached the Ombudsman, and the Ombudsman could not reverse a single one. 257 accounts were frozen in 9 days under the Emergencies Act, and the infrastructure to do it again remains fully intact. Entire legal industries are being locked out of the banking system because banks have decided they are not worth the compliance cost. Your bank account is not yours. It exists at the bank's discretion, and the only protection available to you is not a law, not a regulator, not an ombudsman. It is redundancy. Build it now while you still have the choice. If this video changed how you think about your bank account, subscribe to Canada Pension News Bulletin. This channel covers the financial rules, the tax laws, and the banking regulations that matter to ordinary Canadians. I am Peter Workman. I will see you in the next one.